Okay, this week's market outlook. Starting with the summary. I mean, last week was driven mainly by the US Treasury buyback announcement, which saw the dollar sell off. I believe that was either Wednesday or Thursday. And then we saw risk assets outperform as well. The Middle East situation continues to show no signs of de-escalation. I mean, US oil is now at $86 per barrel. And data-wise this week, we have a pretty quiet Monday and Tuesday before Wednesday, where we get Australia's CPI numbers and core PCE from the US, which is the Fed's preferred measure of inflation. So it's very key. And then on Friday, we have GDP from Canada and then Fed Warsh speaking, as well as some payrolls revisions. So if we actually go to the calendar, not a lot on Monday, some RBA meeting minutes on Tuesday, but not a lot. And then Wednesdays when it gets pretty big, we've got GDP estimate from the US, which is forecasted to slip a bit. We have PCE, as mentioned. Inflation out of Australia, which is forecasted to stay pretty sticky. Thursday, we then have not a lot. And then Friday, as mentioned, we have non-farm payrolls annual revision preliminaries. And then Fed Chair Warsh speaking as well. So that is the calendar. Moving into the currencies. Starting with the US dollar. I mean, so we are bearish for the week ahead, but we are definitely aware of the upside risks. So last week's Treasury buyback announcement obviously triggered a significant move lower in the long end, which initially weighed heavily on the dollar, or it has weighed heavily on the dollar. But what's interesting is that the 30-year itself in the US has actually retraced a good, I'd say 70 to 80% of the move, while the dollar has failed to follow it higher. And at the same time, the US 2-year actually closed the week around 4.24%, which is above the previous weekly close. So this is likely reflecting markets kind of fading the initial Besant Treasury narrative, alongside US oil remaining elevated amid the ongoing Middle East conflict. And what I will say about that is I'm seeing a lot of articles now come out saying that the Treasury buybacks are going to be a lot different than what the markets initially thought when the announcement took place. So for now, I remain bearish on the dollar, particularly while the price action, at least, or the main driver of the dollar, continues to ignore the higher front end. So I mean, the divergence is the main upside risk, where we have a US 2-year rising, we've got the Middle East conflict, but the dollar is going lower. So that's the risk. But I am bearish, and until we see the drivers switch to the short end and we see the dollar recouple, I'm going to be bearish. Moving to the institutions. So Goldman Sachs are bearish on the US dollar, and you give it a pause, have a read, and so are Danske Bank, as we can see here. So institutions are for the most part bearish on the dollar this week. Now, moving on to the pound, we are bullish on the pound, just against the lower yielders. So despite softer UK data on Friday, particularly retail sales, the 2-year gilts, at least in the UK, continue to push higher, helped by the elevated US oil prices and the broader repricing in global rates as well. This keeps the UK's carry advantage intact and should continue to support the pound against the lower yielding currencies. The main risk remains the long end, with UK yields approaching multi-year highs, so I'm talking about the 30-year there. And if this begins to create broader stress across the UK fixed income markets, it could quickly become a negative pound driver rather than a positive yield story. Data this week relatively quiet, so I expect rates, oil and risk sentiment in general to remain the primary driver for the pound. And I only like to express my pound exposure against the lower yielders, rather than across the board. I mean, institutionally, Morgan Stanley are bearish on the pound, and we agree. So moving on to the euro. So the euro is in a very similar position to the pound. I don't see a particularly strong standalone euro story at the moment, meaning that pair selection is going to be extremely important when trading the euro this week. I think rate differentials are not providing enough support for the euro across the majority of crosses, so I expect it to remain on the back foot against the antipodean currencies, those being Australian dollar, New Zealand dollar, and also the oil-linked currencies, so the CAD and the NOK. Against lower yielders, however, like the Swiss franc and yen, I'm more inclined to buy the euro. So institutionally, ANZ are bullish on EU and EG, that being euro pound. So moving on to the CAD. So we are bullish on the CAD this week. The front end is receiving a strong push higher following better macro data, that being the CPI print on Monday, which came in a lot hotter than expected, but also the labour market print two weeks ago, I believe. So yeah, and then coupling the elevated energy prices, it's giving the CAD quite a lot of support, both from a rates and commodities perspective. And with the Middle East conflict showing little signs of meaningful de-escalation, oil should remain an important tailwind. So yeah, as long as oil remains elevated and the Canadian short end continues to reprice higher, I expect the CAD alongside the NOK, as I mentioned, to outperform just due to their link to oil. Euro CAD and GBP CAD are particularly interesting expressions of this view, given the relative lack of support behind the euro and pound, but also CAD Swiss I like the look of. So yeah, that is the CAD. Moving on to the Aussie dollar and New Zealand dollar. So I'll do them together because we are bullish on both of them. Last week's dollar sell-off provided a strong backdrop for high beta FX, even with equities largely ranging, and I expect this environment to remain supportive for both the Australian dollar and New Zealand dollar. The Australian dollar looks particularly attractive given the carry advantage, highest rate in G8, and the rebound across commodities, and relatively resilient domestic data, which will this week's Australian CPI print will either cement or challenge that view. However, it's expected to remain sticky, which could reinforce support for the front end of the curve and keep the AUD carry story intact. So yeah. New Zealand dollar, similar thing. I mean, should also benefit from the combination of softer dollar conditions, a stronger Chinese yuan, stronger commodities, and continued demand for high beta currencies. And unless we see a meaningful deterioration in risk sentiment, I'm expecting both the Australian dollar and New Zealand dollar to remain supported, particularly against the dollar, yen, and Swiss. So yeah, institutionally, Morgan Stanley and Goldman Sachs are bullish on the AUD, as you can see here. Goldman Sachs buy AUD USD on dips between 0.707 and 0.704. Morgan Stanley bullish AUD, however they're neutral NZD on their tactical views. So yeah, moving on to with the yen, as we mentioned, we're bearish. We've been bearish for ages now. The intervention risk just remains. Moving on to the Swiss. So the Swiss is an interesting one because initially last week the Swiss franc caught a bid following the Treasury buyback narrative as long-end US yields fell sharply. However, markets have already begun fading that move, with Treasury yields retracing, while the fundamental backdrop remains unfavourable for lower yielding funding currencies. As long as global yields remain elevated, which they are, and carry continues to perform, which it has been, I'm expecting the Swiss franc to underperform against the higher yielding currencies. So AED Swiss, NZD Swiss, Pound Swiss, even Dollar Swiss. If you get the pullback, I'm kind of forecasting this week. So yeah, bearish on the Swiss franc this week. That's all the macro. Now let's get into the So starting with dollar CAD, I mean, we called this perfectly to the T last week. This was what we did. If you go on the last week's outlook, and I mean, literally to a T, played out. Dollar CAD, sorry. You really want to be playing with whole numbers here, just because the structure is pretty horrendous. Anywhere above the 3.8, I think you're in a decent level to catch maybe a 1-to-1, 1-to-2. But yeah, I'm being extremely careful on dollar crosses this week because number one, they're extremely overextended, and I think there is potential for a sort of mini relief rally this week given what's happened last week. NZD dollar, similar story. I kind of like this. Called that as well last week, which was lovely. NZD Swiss, not a lot of structure. I have a feeling on a lot of these Swiss crosses we're going to end up making some structure before we go higher. GU, definitely this level here. I'll probably be going lower time frame to have a look, but around the 136. G Swiss, same thing, massive sell off on the Wednesday, but I think we'll probably bounce back and end up taking out these August highs. Same with Euro Swiss, I'll probably be looking around the 9325 mark, or we'll make some structure, come back to the 935 and then bounce. Euro NOK. The thing with Euro NOK is you can play it really well with these key levels. So like 2.5s, 0.5s, 4s. So yeah, I'd probably use the fib on this. But yeah, I mean, there's clearly a lot of opportunity. CAD Swiss, 0.58. around there, maybe a bit lower, something like this. AUD dollar, this, if we're not, I really doubt we'll come back to this level. However, if we do, I'm expecting a bounce. AUD Swiss, same thing. We're going to make some structure. I don't see how we melt like this, retrace the whole move, and then we come back down before going. I find that hard to believe. I think what we're going to do is we're going to probably come down here, range for a bit, and then we'll go again. And that is it for the technicals this week. ES still clearly moving to the upside, but bit of a pullback last week. And to be honest, I wouldn't really know where to get in. It's very dependent on a lot of things right now, which is obviously new Fed chair, the front end of the curve, Middle East. There's so many variables, and I think when you like come down here into one of these extremely discounted levels, it's a no-brainer. But I just don't. I don't like buying around here. But yeah, that is the outlook for this week.